All right, wanting to work with you guys again, and again, I still don't think it's effective to lecture and talk about formulas. I got good feedback that it helped walking through the mini problems. So what I want to do is walk through a couple of the example problems from Chapter 7 and Chapter 8. I really would appreciate your feedback. I want to find what not just teaches you how to find the solution, but then if you couple that with the PowerPoint, you'll understand what that solution means. So what we did right here. So we've actually got the dividend yield of 10%. The initial was $21 value of the stock. So if you have a lower required rate of return, the value of the stock increases. Or if you have a higher growth rate, the value of the stock increases. And you can see the value slightly higher than Part B, even though the denominator is the same, 0.8, the higher growth rate has created a higher expected D1, which adds the 50 cents in extra value. You missed my air quotes when I said that. All right, let's talk about Chapter 8 problems. Chapter 8 problems really go into lease financing. So, this is evaluating lease versus buy in a lot of these different options, and what is the most effective way to manage your debt and your cash flow. Those are some of the issues that you're going to run into. So let's suppose Suncoast Healthcare is planning to acquire a new x-ray machine that costs $200,000. You can lease the machine under an operating lease or buy it from a loan from a local bank. Or if you're sitting on cash, a whole nother analysis would be, what if we gave up the cash flow? What would that do to us? You know, it often comes down to at what interest rate are people going to do that, and you know, what is the cost and what is the interest that you can earn on that cash. Say we're earning 2% interest on the cash, so not much, and the interest rate we would pay on that loan would be 4%. Well, it's actually more cost effective for us to use the cash than pay the interest. If it were the other way around, it makes more sense to lease it and get higher interest on our cash. So that's just another calculation that goes in this whole lease financing when you're talking about lease versus loan versus actual cash outlay. So not part of the problem, just wanted to walk you through that as an explanation. So here we go. Their balance sheet prior to acquiring the machine is as follows. They have $100,000 in current assets, $900,000 in fixed assets. So their total assets are $1 million. They have $400,000 of existing debt and $600,000 of equity in that $1 million total claims. So, first question, what is their current debt ratio? B, what would the new debt ratio be if the machine were leased or if it were purchased? And then C, finally, is the financial risk of the business different under the two alternatives? So, first and foremost, the current debt ratio is total debt over total assets. Total debt, $400,000. Total assets, $1 million. So their actual debt ratio is 40%. Pretty simple. If the new machine were leased using an operating lease, it would be listed not on the face of the balance sheet, but in the footnotes. Thus, the business debt ratio stays at 40% if it's an operating lease. So that doesn't change. If the $200,000 machine were purchased, the assets are actually going to increase to $1.2 million. And total debt increases to $600,000. So now we do the debt ratio, it's 50%. So then let's go down to that last question. Is the financial risk of the business different under the two acquisition alternatives? Really, it's the same. Their debt ratio will change a little bit, but really it's the same, and here's why. Debt financing and leasing both obligate the business to a contractually guaranteed series of cash payments. You're either paying it out on an operating lease or you're paying it out on a bank loan. So if you default, the machine's going to be repossessed either by the lessor or by the bank. So the creditor and the lessor would both be able to force the business into bankruptcy if necessary to get their dollars back. So the risk is the same. It all comes down to what comfort level do you have with your debt ratio. And then as we get later on and we talk about bonds and bond ratings, if we get into that later, there are minimum requirements or maximum requirements of debt ratio. So that would come into play here. But in the big scheme of things, aside from changing the debt ratio and moving some things around on the balance book, one sitting on, one sitting off, the risk is the same. You're acquiring a $200,000 piece of equipment and you're using someone else's money. If you don't pay for it, they're going to get their money. So, let's talk about problem 6. M&O Emergency Services is negotiating a guideline lease for 5 new ambulances with Leasing International. M&O has received its best offer from Better Build Ambulance for a total price of $1 million. Does the price of these things start shocking you guys yet? I don't know how much time you've actually spent in healthcare, but on capital acquisition, but these are pretty accurate prices. So the term of the lease offered by International Leasing calls for a payment of $205,000 at the beginning of each year of the 5-year lease. As an alternative to leasing, M&O can borrow from a large insurance company and buy the ambulances. The $1 million will be borrowed on a term loan at 10% interest rate for 5 years. The ambulance fall into the MACRS 5-year class. Remember how we do accelerated? And have an expected residual value of $200,000. I'm sorry, I didn't finish accelerated, but it's accelerated depreciation. Maintenance costs are going to be included in the lease. If the ambulances are owned, a maintenance contract will be purchased at the beginning of every year for $10,000. M&O plans to buy a brand new fleet of ambulances at the end of the 5th year. Leasing International has a 40% tax rate, while M&O has a tax rate of 20%. So, what is the present value of the cost of owning the ambulances to M&O? What is the present value of the cost of leasing the ambulances to M&O? And what is the net advantage to leasing? Should M&O lease or buy the ambulances? Let's walk through it. So, if you've got the before tax cost of debt of 10%, tax rate of 20%, and you've got your accelerated depreciation and a maintenance cost of $10,000 per year with a residual value of $200,000, your lease payment of $205,000. So let's look at the cost of owning in year 1 through year 5. You can see actually as it goes out with the net purchase price, you're owning, so you're paying that $10,000 maintenance cost. You've got a tax savings on the maintenance. You've got a depreciation tax savings. Notice how under the accelerated, we're depreciating them more rapidly. Comes down to your net cash flow per year and by year 5. So the actual cost of owning is the net present value, taking into account all our calculations up here. Our cost of owning is $762,000. Our cost of leasing is essentially the lease payments. So we've got our lease payments and the lease tax savings of $41,000 because we've got a 20%, right? $41,000 is 21% of $205,000. So our net cash flow per year is $164,000 versus that $1 million we're laying out right at the beginning, right? So the actual net present value of leasing is less. There's a $55,000 advantage to leasing versus owning. So ultimately, M&O should lease the ambulances. Let's take this a step further. If International Leasing, the leasing company, if they have an alternative to leasing the ambulances, is to invest in a 5-year certificate of deposit that pays 9% before taxes. This is International Leasing deciding, is this a good deal to use my cash? Is it a good deal for me to use my cash to lease the ambulances to them? Or if I invest that cash in a CD that pays 9% before taxes with a 40% tax rate, what am I better off doing? So this is the other side of the equation in the company that's leasing, trying to decide, is it smart for me to use my cash this way? So you've got a cost of debt at 9%, tax rate of 40%, so you've got your after-tax cost of debt of 5.4%. See the math? Maintenance cost, residual value, lease payment. So the net purchase price, because now International Leasing is buying the ambulances for $1 million, they're now having to buy the maintenance cost year in, year out to take care of their asset, which is the ambulance. There's a tax savings. 40% of that is a tax savings because that's the cost of maintaining their device, maintaining their ambulances, $4,000 a month. Then you go into the accelerated depreciation of our $1 million, so we're depreciating them, getting down to that $200,000 residual value. Add those up, your residual value is going to be $200,000. Your tax on your lease payment, you can see across, residual value, tax on residual value. So now we actually see the net cash flow from year 1 to year 6 when we get rid of the asset, or we go, the residual value is $200,000 and it's out the door. So we calculate the net present value. The net present value is actually negative $32,000. So the value of their money is actually negative $32,000 on the lease, where they could actually earn 5.4% after taxes on the CD. 5.4% on $1 million versus a negative cash flow. Don't write the lease. The terms aren't favorable. So what would International Leasing have? They would have to come back in and increase the lease payment to M&O in order to find that place where they're actually more favorable at leasing than they are reinvesting their money somewhere else. Alright guys, a couple of walkthroughs for some problems, trying to help you go through that. Please give me feedback on this helping. This is kind of what I thought as I walked through. I thought that walking you through the problems while you review the PowerPoint on your own to understand what these numbers mean and what the theory is may help you. I want you to learn not just the equations. I want you to understand what's behind them all. So let's try it this way. Give me some feedback. Thank you.